Good afternoon, everyone. My name is Raphael Karuaihe, and today's topic is, I thought it was probably a trivial topic in the sense that, people take for granted who's a hedger and who's a speculator, but I thought I would go through it one more time, just explaining in layman's and by examples, just to see whether we are on the same page on that one. If you are an experienced trader, probably this may bore you, but hang in there and let's see at the end of the day whether you got what you wanted to hear. And I thought, let me just recap a little bit on some of the futures lingo that we use, because I think it will be helpful in the examples that may come up, where we say a long position is a position that allows one to profit or to be protected from a rise in the price of a commodity. And a short position is the opposite, which is basically just a position that allows one to profit or be protected from a decrease in the price of a commodity. Now, farmers owning stock or owning the mealie in the field are said to be naturally long in the cash market, and the processors or millers who are the users of the raw commodity are naturally short, or they are always in need of a commodity. So those are the typical lingo that is used in the industry. So in essence, to be long is to buy, and a short would be a sale transaction. So just keep that in mind as we go through the hedges and speculators. Okay. Again, just another recap on the function of the market, including the participants. We say that a futures market would provide a price risk management and price discovery platform for the South African grain market through the derivative instruments. We do have two distinct classes of participants, who are the hedgers, typically farmers and millers, and the speculators, whom we're going to explain shortly. Currently at the JSE, we've got about 60 member firms or brokers who facilitate. We do also facilitate physical deliveries. In other words, if you want to trade your mealie and end up delivering via the exchange, we do have a system, a process in place to transact that. And we also then have clearing houses who act on behalf of the JSE clearing house. And typically these are the five major banks who play that role. And these are the guys who would then be giving you profit and losses transcripts at the end of every trading day, basically. So we would then just focus today on hedgers and speculators, but just to give you a bigger picture on the market participants in general. Now, hedgers. Hedgers have a vested interest in the underlying commodity. Just like we mentioned, they're either a farmer or a baker or a miller. Those people ultimately need the physical commodity at the end of the day. So those one would then be having a vested interest and trying to take a position to protect themselves. They can be, I indicated there, they can either be, now if we talk of non-agricultural commodities, it could be mining companies that look at the precious metals and so on, could be foresters looking at timber and all that stuff. It could also be oil drillers, for that matter. And so those are people or institutions that have got vested interest in the actual physical commodity. Or they could be jewelers, for example, or oil distributors as well. Now on the buyer side. Okay, so hedgers are interested in protecting themselves now against future price changes that will undercut their profit, because normally you make forecast, you do budget, and you do all that. Unfortunately, that you do now, but without knowing what will impact on the price 3 months down the road. So, so overall hedgers are seen as risk averse, who would then want to pass on their risk to someone else who's a risk taker or a risk lover in that sense. And as you would see, or you thought about it, this then would be typically your speculators. They reduce their risk by taking an opposite position in the futures market to what they have in the cash market. That's a very bold statement. That's why I highlighted that, and I will challenge you as we go through the slides. So in other words, remember what we said about a farmer. We said in the cash market, a farmer is naturally long. So if he wants to hedge himself, he then has to go take a short position, which is then the opposite position of in the futures market to his position in the cash market. So just bear that in mind. And in fact, that is a fundamental definition of hedging. You would recall, if you are a trader who has been in the industry for a long while, you may experience a situation where you actually sell or say buy a future as a farmer, thinking that you're hedging yourself, but actually you are then having a double whammy of overexposure. Thus, farmers would sell or take a short futures contracts, while millers would then buy futures contracts to protect themselves, respectively. Let's just take this example. It's just a verbal statement. We are not going to run through any numbers or so. So assume a company specializes in producing gold jewelry, and it has a major contract due in 6 months down the road. The company is worried about the volatility of the gold market and believes that the gold price may increase substantially in the near future. Now, if you already made an order now, you gave a quotation to your client that this is going to cost you this much for delivery 6 months down the road, then you already committed at that price. Now, any future increases of the input, in this case gold, may then jeopardize your transaction, because you can't go back to your client and say, I want to adjust my order or my price for that matter. So in order to protect itself, such a company could then buy a 6 month futures contract in the gold market. This way, if gold experiences a 10% rise, the futures contract would lock in a price that will then offset this gain. And that's actually what then hedging would mean, because you lock in a price, and after that you don't really mind anymore whether the price goes up or down, because you have secured a fixed price at which you can actually now do your transactions. That's a typical example of a long hedge, because this would be somebody who would then be needing gold as an input in his jewelry. Please note that although hedges are protected from any losses, they are also restricted from any gains, as can be seen in the following example. And here what we are saying is, once you lock in at a fixed level, at a fixed price, any price direction is not there for you to gain, but it will just be for you to lock in at that price, irrespective of the price movement. So if you say that I'm comfortable to lock in a price at 1,000 Rand, for argument's sake, if it goes to 1,100 or 900, is immaterial for you as a hedger, because you already locked in at the committed price of 1,000. I think that's what the statement means. And let's take a quick example here. You see here we've got a date, we've got a contract, and the example here is about a maize contract where two parties would then enter into a transaction, a seller and a buyer. So the seller of maize would then be typically a farmer, and the buyer of maize would typically be either a miller who has to mill that commodity, or it could be a speculator who just wants to profit from the transaction. Now, on the 4th of July, arguably, and please don't take take me to task on the prices. I think this is just for illustrative purposes. The numbers may not be exact, but although they were in those ranges. So the contract price, in other words, a white maize contract on the 4th of July was trading at 1,750 Rand per ton. In other words, if you are in trading this market, you will know that one contract of maize is equal to 100 tons. So the contract value then would then be that price per ton multiplied by the 100 tons to give you the total exposure of that of that transaction. Now, in the futures market, you also know that every participant would then be required to put in what we call a deposit of good faith. So both the seller and the buyer are required to put in each 10,000 Rand. And this is the beauty of derivatives, because you see that you have an exposure to 175,000 Rand worth of goods, but you are only required 10,000 to start participating in that exposure. And this is actually why people say that derivatives are high risk instruments, because if you gain, you gain almost tenfold, but if you lose, you also lose almost tenfold. So that's a high leverage in the derivative instruments. Let's continue with our transaction. Now, I would argue then that the 4th of July was a Friday, so the 7th of July would then be a Monday. And we see that the price went from 1750 to 1745. So it dropped by 5 Rand per ton, basically. Now, what happens? Because remember, on Friday, each person was then required to put in a down payment, so to say, in their respective accounts, 10,000, 10,000. Now, remember that any transaction of this nature is actually a zero-sum game. In other words, if the seller gains, then the buyer would lose, or the other way around. So in this case, 5 Rand per ton multiplied by 100 tons, which is one contract, we assume we only traded one contract, is equivalent of that 500 that you see there. So then you see that on Monday, money will flow from the buyer's account into the seller's account, that 500 Rand. Why? Because remember, the seller who locked in at that price actually protected himself against falling prices. So the farmer, the reason why the farmer hedges himself is to say, I'm comfortable selling my maize at 1,700 Rand and not less, not below. So in this case, if the price goes down, the hedge that he took would have then protected him. That's why he gains that 500 Rand there. And for the buyer then, you see that he would then be required in terms of the rules to then put in an additional 500 Rand into his kitty, because he needs to maintain his account at that 10,000 minimum. All right. And by the way, we have excluded a lot of transaction costs and stuff like this. So this is a very basic explanation. So if you are an expert, you would laugh at this probably and say, what about the actual variation margin? We didn't consider any cost or anything in this transaction. So on the 12th of July, the price went then up by 2 Rand per ton from 45 to 47, and you see that then this would cause a reversal of the transaction from the seller's account back to the buyer's account. But you would see that because the deposits in the account, the one has got 10,300 and the other one 10,200, there is no need for a margin call. In other words, no one is required to put in an additional amount because both accounts are still above 10,000 each. So this is a mere movement then from this account to that account. And this will drop by that 200 to 10,300, and this will gain from 10,000 to 10,200. Okay, and so it goes on like that, and so you get the long of the short. And ultimately, come the 18th of July, and we just took arbitrary numbers really, the parties decided to exit their position. And how do you exit a position? It's actually if you were if you bought one contract of maize, you sell back one contract of white maize of grade 1, and then you are neutral and you don't have a position anymore. So that's a way of exiting your position. So now here, the most important thing is to look to say, when we ended on the 4th of July, the price was 1750. When we are exiting a week later or 2 weeks later, the price is now at 1710. So it's an overall drop from 50 to, it's an overall drop of 40 Rand per ton. That's what you see there. And we'll see that being reflected in our calculation here. So let's look at the seller, who in this case would then be typically a farmer who sold a contract. We said that he is naturally long in the cash market. So for him to hedge, he has to take a short position, which is a counterbalancing position to what he has in the cash market. So what about him? He receives his margin. In other words, now when you close your position, your initial deposit of 10,000 gets returned to you, plus he would then get 4,000 Rand because he benefited. Remember what we said? Opening account was opening price was 1750, closing price is 1710. The difference is 40 Rand per ton times 100 tons is 4,000 Rand, and that's what you see there. So in as much as he gets back his 10,000 deposit, he will also now gain 4,000 Rand in the futures market. But remember, the seller now, when he goes into the cash market to sell his physical good, his actual maize, the going price in the cash market now for the day of the 18th would only be 1710. So he will go into the cash market and sell it at 1710. But remember, he wanted 1750. So the difference he will then gain from the futures market. And that's what we are saying, trying to explain there. So he would get sell at 1710 plus 40 Rand that he gains from the futures market. Then he will get back to the original hedging level, which was 1750. So that's what hedging is all about. Irrespective whether the price went up or down, the original price at which you hedged is what you get. That's basically the message. And that's the same again with the buyer. Now the buyer, of course, lost, because whatever the seller gained, that 4,000 Rand, means that the buyer lost that 4,000 Rand. But the good news, since he is a buyer, he is going to buy at less than anticipated. He was comfortable to buy at 1750, but in the cash market, he can buy for less now. So ultimately, he would still then go back to that 1750, just like the seller. And for him, that is better than being having an open-ended position where you don't know whether the price is going to go up or down. So it's almost really like insurance, where you say, I would rather than be happy because I was originally happy with 1750, rather than that price going to 1850 and I can't then afford it to buy that maize anymore. So that's the short, the long of the short, or the short of the long. So this message is just trying to explain what we said in the earlier last slide, where we said you are protected through the hedge, but you are not really profiteering through the hedge. So what exactly is hedging? In the context of futures trading, this is a very good definition, and I'll leave it. These slides will be available on our website. You can have access to that. So what we're saying, it's a counterbalancing transaction involving a position in the futures market that is opposite to one's current position in the cash market. And again, like my usual example of the farmer who is naturally long, or he owns the millie, he would then take an opposite position, which is then a short position, if he wants to hedge himself in the futures market. Let's move on to speculators. Again, just a standard definition. Speculators are those market participants who use derivative contracts not to manage price risk, because they really don't have any underlying commodity, but with the purpose of benefiting from a directional move in the derivatives market. So they are there purely for profit. And as a result, they spend a lot of time doing research, trying to guesstimate the direction of the price, and based on that enter the market. So speculators analyze and forecast futures price movement, trading contracts with the hope of making a profit. They put their money at risk and must be prepared to accept outright losses in the futures market. Speculators enter the futures market when they anticipate prices are going to change. Of course, if it remains flat, it means you can't make a buck or two. Again, the universal law where you buy low and sell high, and the difference is a profit. Or you sell high and buy back low, and the difference is your profit. So if the price remains flat, then it's not good for the speculator. So while they put their money at risk, they won't do so without first trying to determine the best of their, or to the best of their ability, whether the prices are moving up or down. So they put an effort, they do some research before they really bet and put their money there. Speculators assume risk for hedgers, which is very good, because imagine if no one was willing to take the risk of the hedgers. We may not have a market. In other words, the hedger may be desperate to lock in a price or hedge himself, but there's no willing counterparty. So speculators are a crucial part of the whole market, of the whole futures market. And therefore they are crucial to the success of the futures market because they complete a symbiotic relationship between those wishing to avoid risk and those willing to take the risk, and thereby allowing liquidity in the market. In other words, the ease of getting in and out of the market because of the presence of the speculators. Speculators make bets or guesses on where they believe the market is headed. For example, if a speculator believes that a stock is overpriced, he or she may already take a sell or short position. So he short the stock and wait for the price of the stock to decline, at which point he will then go into the market and buy back the stock and receive a profit. So typically that's what a speculator would do. Speculators are vulnerable to both the downside and the upside of the market, and therefore speculation can be extremely risky. At least the hedger is backed by the physical commodity at his disposal, but the speculator can be quite exposed if he got his research wrong, or he got his market direction wrong. All right, in short, that's the difference between hedgers and speculators. Please feel free to put any questions that you have, and we'll be glad to respond to them either now or in future. Our contact details are on the website, and we'll be more than willing to assist where we can. Thank you.